Hello, everyone. My name is Paul Zwi, and I'm joined today by Clime's Executive Director, John Abernethy. John, I'd like to start off with a bit of good news. And I saw overnight that the 7-day average of COVID cases in the US is down 72% since it peaked on the 11th of January. This is obviously very, very good news, and it feeds into the whole reflation theme that we're seeing with markets doing well, but also with rates rising. Now, how do you see that? Is this an unmitigated good story, or?
Well, it's good news. I think there's a lot of focus in America about some short-term numbers, always looking backwards, and particularly employment. So there was some sort of recovery in the American economy after the downturn. That was mainly through fiscal stimulation, a bit like Australia. They got the economy off the bottom, got activity improving, consumers starting spending online. So that was the first bit. Then it stalls a bit because they didn't really have a proper policy for dealing with the virus. Now they do have a policy to actually have vaccination. So I think when you look out the next couple of months, you'll see employment numbers for America clearly improve, which will then start some of these pundits changing their views. The American economy stalling, and it'll start recovering, just as the Federal Reserve is saying. It's an uneven recovery. It requires continual management with lower interest rates and support from fiscal monetary policy. But we're over the hump. Recovery is there, and that's consistent with our views, which we've expressed for months now, that the human race is genius. It'll solve the problem. Yes, there's going to be other issues develop, but the whole of the human race is onto this, and they will solve this problem. And from an Australian perspective, it's more good news that America leads the rest of the world into recovery. Australia is a trading nation. Yep. We get caught up in that, as well as the Chinese recovery, which is well on foot as we speak. So it confirms our view.
Yeah, I'd just like to drill into the question of interest rates a little bit more, because a lot of the talk and the nervousness in markets over the past week has been the rapid rise in the long bond rate. So we go back to the start of the year, 10-year government bonds in Australia were at about 0.9%. In the US, very much the same. Now we're in late February. The 10-year bond rate in Australia is 1.6%, a massive increase, and in the US about 1.3, 1.4%. At what point does a rise in the long bond rate stop saying that we're in recovery and start becoming a bit of a problem for the market?
Let's be realistic. The bond market, particularly the 10-year bond market, has a whole lot of influences. Some of it's panic, some of it's logic, and there's a lot of manipulation. There's three issues to address. Now, when the bond market rallied, the 10-year bond rallied to 0.9, I'd put that in the panic category. Bond yields collapse at the long end, panic. Everyone goes for a secure investment. Logic is playing out a bit. If the central banks of the world are telling you they're targeting 2 to 3% inflation sustainable, then it's hard to justify a 10-year bond trading much below 2% in the realistic world. But the manipulation continues. Now, the manipulation activity of central banks is clearly, outside Europe and Japan, more focused at the shorter end, 0 to 5 years, than 10 to 20 years. Now, the 5-year bonds in Australia, which everyone ignores, Australia's 0.7, America's 0.6, 5 years.
Yeah.
Now, anyone investing in the stock market should be having at least a 5-year view when they come into the market. So the comparative return from the bond market at 5 years is still pathetic. And I even suggest even 1.5%, 1.6% 10-year bonds is pathetic, given the view on inflation.
Still too low.
Still too low. Yeah. And I think the danger is looking at points of time in the past, not realising what was going on. Was it manipulation? Was it panic? Was it realistic? Now, 0.9 on a 10-year Australian bond was never realistic. And 0.9 in America, not realistic. But let's have a look at reality. It's negative 0.3 in Germany at present. It's negative 0.1 in France at present. I mean, is that realistic? So there's a long way to go before bonds, in my world, the way I think, are a challenge to the equity market. And it's got to have a clear 2 in it all around the world. Now, what's unfortunately for Australia is the issue about our long-term rates are higher than the rest of the world. In America is interesting.
pushes our currency
pushes
up.
the currency up.
Yeah.
We're approaching 80 as we speak.
Yeah.
And remember that our trade flows are still very, very strong. If we had inbound tourism checked by the Australian dollar going up, well, that'd be interesting. But we don't have inbound tourism checking the Australian dollar up, and we've got tremendous amount of activity in Australia with internal tourism. So there's a lot of factors that play on the logic thought process.
I'd like to bring this back just to the investment opportunity for our viewers. And with this reflation trade, we've seen commodity prices going up. Do you think that this is the start of a new super cycle, or are we just lucky enough to be experiencing a synchronized growth recovery with the main economies doing pretty well, and it's going to last a year or two, but not a super cycle?
Yeah, well, I think commodity prices are indicative that the outlook is good.
Yeah.
And after a hibernation period of the world, and that hibernation period dampened down demand and also supply. So when demand ratchets up quickly, and when it's clear going out 1 or 2 years that synchronized growth is here, that there is a supply constraint which has to be stoked up quickly. It's not being stoked up quickly enough. And then you get the manipulation players or the hedge funds who come in and say, look, copper's going up, let's jump on that one. Sure. And they drive the spot prices up and the futures prices up because they know there's strong demand coming from the world. Now, they want to be careful that they don't ignite problems, alternatives, or they ignite inflation, or, that's the biggest risk, that this speculation ignites something that the world doesn't need. That the world is in recovery mode, synchronized, as you said, or everywhere you look out 12, 18 months, it's clear the world is going to recover.
But do you think commodity prices, particularly base metals and the bulks, are these high prices going to be sustained?
Probably not. I'm not in. I've been around too long to believe that this is a new cycle for commodity prices. The world's been growing since year dot. It's had tremendous growth period as China entered the industrial world. The Chinese growth is going to slow, but it's going to be sustained. India's got to come in strongly. There's just steady growth. It's not a change in anything. Yeah. It's just more of the same, accelerating for a period and then going back to normal for a period. It's not as, I don't believe the super cycle stuff because I think it's too much manipulation and too much speculation in markets.
But when we look at Clime's portfolios, we are introducing and weighting some of the
commodities.
high quality
commodities. We're not buying stocks based on spot prices. We're buying prices on historical prices of commodities. Now, copper, if it fell 20% and held there for a few years, that's still a great result for copper producers. $4 in my world throws up
BHP.
For BHP, and we've got sustained strong prices in iron ore. You look at the Australian budget, which was printed in October. Here we are in February, March. It's only out by $120 a tonne, so that's pretty good by the pundits. Yeah. Now, our view is if iron ore fell back to 120, 130, that's still a great price, tremendous margins.
Fortescue still making very good money and paying out huge dividends.
Yeah. So that's not going to change. Yeah. Okay. The dampener is the Aussie dollar. Now, I guess you're going to ask some questions about that, but I'll preempt you. We've been saying constantly when the Reserve Bank gives its forward guidance on interest rates, it's saying a cap of 0.1, and it keeps on using the word a cap. The risk, I think, is heightened as we get to 80 cents that the cash rate of Australia may go to zero, it may go negative, and that will be quite shock the market, I think, at some point when that happens.
Wouldn't it make more sense to leave the short-term rate where it is and just start buying up those longer-dated bonds?
Well, that would be the Paul Keating view. And I think there's some logic in that, actually. I mean, when you do bond market management, I think you've got to be across the yield curve. But we've got to look at it from the investor's point of view. Yeah. And when I put the investor hat on, I put the asset manager for a long-term pension fund who does want a substantial part of their portfolio in stable yielding assets. Now, if we crunch the long-term bonds, say the 10-year bond, back to 1%, then a sensible, large pension fund has a real problem. So letting that long-term yield go towards 2%, matching inflation, does give some relief to those large pension funds who actually have to manage liabilities on longer term. Yeah. So we've seen what happens in Europe when you crunch interest rates long term to negative, and Japan you create a massive asset bubble on the equity market. So I think the Australian Central Bank should do a little bit of what you say, just to keep it orderly. But having short-term rates, I agree with you. Negative would not be great. It's sort of like something you pull out of the bag if all else fails. But you may threaten it. I think there's a threat coming from the central bank that if the Australian dollar doesn't slow, they will threaten to cut interest rates to negative. I expect that in the next 3 or 6 months. So get ready for that one. That may stall the currency, may do the trick. If it doesn't, then they will have to compress those long-term rates, which are attracting not only Australian pension money, but pension money from all around the world. So if you're sitting in Canada, you're sitting in North America, Japan, Europe, I can get 1.6, 1.7 on Australian AAA rated bond with a rising currency. It's sort of
win-win.
It's a win-win. So it's a difficult point, but I'm not worried about those interest rates.
Okay. John, I just want to finish off on the reporting season that we've just come through. We're pretty much through it.
Yeah.
Any particular features that you observe that will help us manage the rest of the year?
There's two. Part of three, the resources I think you've mentioned, and the high dividend payouts, which is good. The banks look like the worst is over, so there's right backs coming. So there's probably an outlook for growing dividends from the banking sector, which effectively offsets their low growth outlook, so that they go back to where they were. So there's a little bit more upside there in the banks on yield. And I think the non-discretionary retailers, they're great results. I've listened to both CEOs of Coles and Woolies trying to explain that was an aberration. I don't think
on the discretionary retail side,
and the discretionary is strong as well. But I think when you stop Australians travelling overseas, you give them cash handouts.
They're going to spend.
They're going to spend it. Now the cash handouts stop, we know. But there's a significant part of the population who is not going to travel for another year overseas. So I still think the good times are rolling on.
And we've still got a bit of a rotation from some of these sort of tech names and high PE names into more value stocks. Do you think that's got further to go?
A little bit. There's definitely this rotation in markets. The IT sector, I think you've got to be very, very specific about what you buy. You've got to buy companies which are making money, have good technology, well capitalized and making money, as opposed to companies which have technology but are not making money and are on inflated multiples. There's a day of reckoning coming, but if we get the IT sector both in Australia and America pulling back and it pulls down the good IT companies, that's an opportunity to buy those. So it's a bit of a rocky road there, but nothing really to worry about.
All right. Well, thank you very much for your attention, and I hope that you took some useful information out of that session. Thank you.